Good afternoon, everybody. Chris Gorman here with this week's installment of Real Estate and Money. And today, what we're going to talk about is a potential looming commercial real estate crisis in the works that is unfolding before our eyes if we're paying attention to the right places. Before I get to that, though, I do want to quickly just touch on, since we've been talking about SVB and the banking crisis the last couple of weeks, I want to touch on that. So over the weekend, Raleigh's own um, First Citizens Bank acquired the assets of Silicon Valley Bank in a deal structured along with the FDIC to acquire 90 billion dollars in assets at a $16.5 billion discount. So First Citizens is now one of the largest banks in the country as a result of this deal, which is pretty cool for Raleigh. We'll see what effect that has long term on the area. Just kind of further goes to the growth that we're seeing here in the Triangle. Um, so yeah, so losers and winners on both sides. Obviously, losers on the SVB side, and First Citizens has a real opportunity because they have, while they've inherited some risk in their portfolio, which they're sharing with the FDIC, they got a heck of a deal on the surface, at least. So we'll see how that plays out. I do want to also touch on the fact that as a result of this banking failure, um, the SVB in particular cost the Deposit Insurance Fund about $20 billion. And so the Deposit Insurance Fund is an insurance policy that is paid for by all the banks in the country that participate in this program to basically insure deposits over and above the $250,000 FDIC limit. So 20 billion is what they took from that fund, which will have to be paid back. The premium on that policy is certain to go up. The banks have to pay that premium, and ultimately they get the money to pay for that from their customers. So they're saying this isn't going to be taxpayer funded. It's not technically, and yet it's bank consumer funded in the end. Um, they'll find a way to add some fees into their banking products to recoup what they've lost. So that's all I'm going to say about that for now. I do want to pivot to the commercial real estate crisis in the making. I'm going out on a limb a little bit here in making these comments, but hell with it. I'll do it anyway. So, why am I saying this? Well, if you think about what happened in 2007 and 8 with the residential mortgage crisis and why that happened, uh, a lot of similarities in the commercial real estate world, not so much on the mortgage backed security side, although that does play into it, but my little thing's blinking here and I'm not really sure why, so I'm just going to turn this off. Yeah, so not so much on the mortgage-backed security side, but on the debts, it's on the debt itself, which I guess then impacts the derivative markets as well. Um, these commercial loans, most of them come with what are called balloon payments. So if you have a 20-year loan, which is pretty common for a bank or for a, a commercial real estate loan to be a 20-year term, that means that they amortize the debt over 20 years. Um, could also mean that it's an interest only loan. That's also very common with a balloon payment. So let's just back up for a second. If you take a commercial loan over 20 years and they amortize that like they do a home mortgage, they're front loading all of the interest on that loan. So if you think about your mortgage payment, that first payment that you make is going to be like 90% interest and 10% principal. I don't know if it's actually that, but point is, with every payment you make, you get a little bit more principal and a little less interest. But they're recouping the majority of their interest, which is where they make their money on the front end of the loan because most mortgages are only held for about 5 years. So in that 5 years, the consumers paid down very little of the principal in comparison to the interest that they've paid. And with commercial loans, a lot of times they'll say, you know what, we're not even going to require you to make any principal contribution. We're only going to charge you interest. And so you're going to make an interest only payment up until the point where that balloon is. And what is a balloon? Well, it's basically paying off the loan in full. So if we're amortizing the debt over 20 years with a 10-year balloon, then that means in 10 years, you either have to refinance or pay off the debt. Paying it off with cash usually isn't an option. So developers and owners of commercial property typically look to refinance their debt. The problem is if you're building your economic model on very low interest rates and an interest only loan, you've got your income and your expenses, right? And if there's more income than expenses, then you have a profit, and that's what you're going out and you're raising money on, and you're getting investors to come help you fund these projects. Well, if all of a sudden your expenses shoot through the ceiling because your new loan isn't the same interest rate as your old loan, and your income side hasn't balanced out, then you're in trouble. And that's what a lot of people or a lot of developers are finding themselves in today. We've already seen a couple of projects in New York City and Los Angeles fail, and basically those buildings were sold for their debt balance. So if you have a $20 million project and there's 15 million in debt left on the loan, these assets are being sold for that 15 million, which means that the buyer gets $5 million in free equity. Basically, it's a distressed product, and so that's why I bring it, kind of tie it back to the residential mortgage crisis, because in that way it's similar. A lot of investors during that time were able to buy distressed homes at bargain prices, right? And now 10 years, 15 years later, they're sitting pretty. I mean, those assets have tripled in value in some instances. So the same opportunity may present itself here in the commercial real estate market. We'll just have to wait and see. Um, but depending on how many of these things fail, um, you know, just like in the residential mortgage crisis, uh, that whole all those failures kind of forced everything down, right? Regardless of whether or not your house had any problems, you were making your mortgage payment, your house was fine, but the value went down as a byproduct of everything else that's happening out there. Well, we're likely to maybe see the same effect in the commercial real estate world. So if you have enough of these failures, that's going to create a lot of distressed assets, which is going to force the values down on everything that's not distressed as well. And that will present some opportunities, I think, in the investing space. I probably wouldn't be putting any money into commercial real estate assets right now. I would be waiting to see where all this plays out, because I think towards the end of the year, we may be able to look back on this video and say, okay, this was a little bit predictive. Um, and I think that if you have cash on hand, you may be able to, if investing in a commercial building is something that you've been looking at, I know it is for me. I think an opportunity may present itself later on in this year. We'll just have to wait and see. Obviously, I'm not rooting for any of this. I never root for disaster. But if you're a savvy investor, and I certainly try to be, I've got a lot to learn, but you have to be in a position to get lucky, and luck favors the prepared. So if you've got cash on hand and this is an investment vehicle that you are attracted to, um, then watch it. Watch and wait. I think there will be some opportunities to present themselves in the next 12 months. Now, will this trickle down into the residential market? I don't think so. I really don't. Completely different landscape in the residential world. Residential market's still very healthy, still way more demand than there is supply, and mortgage rates, while higher than they were this time last year, are still very reasonable and affordable. So I don't expect that this will have any impact on the residential market. The only possible pathway for that to happen, I suppose, would be just general panic that any crisis causes, and we just saw what that looks like in the banking world when all this stuff the last 2 weeks was going on with some of these regional banks like SVB and Signature Bank and First Republic Bank. You saw all the bank stocks go down, even the big banks like Bank of America and Wells Fargo, which their balance sheets were actually getting stronger while this was going on, because if there was anybody with money at a regional bank that was spooked by this, what do you think they did? Well, they moved it from the regional bank to a big bank, a big national bank like Bank of America, for instance. They saw their deposits shoot through the roof, but their stock was still trading down here at a depressed depressed level due to kind of this contagion, panic, fear aspect of people just leaving the banking sector in general. So that should present an opportunity long term. I think we're going to see a similar opportunity play out in the commercial real estate market as we go throughout the year. But we'll just have to see. This could all be wrong. I don't think so. I think there's too much evidence to say that this is pretty much inevitable. Um, the effects are, how deep and wide the effects of it actually run is what's up in the air in my mind, at least right now. But I'll be sure to continue to monitor it and, make predictions as we go along the way. If investing in real estate, in particular commercial real estate, is something that you're interested in, please do reach out to me, and I can make sure to keep you posted on anything that I hear that may affect the landscape as we go throughout the next year. So that's all for now. And if you liked this, if you felt this was informative, please share it. It helps me reach more people, and I'd certainly appreciate that. Thanks so much, and have a great week. Bye bye.